what is the really most brutally honest way of evaluating one's wealth? And how does one actually look at cash flow as an issue when it comes to that particular portfolio? What's an ideal picture for any of us, especially the ones in this audience?
Correct. So, firstly, I urge each of you to draw a balance sheet. Companies make a balance sheet every year. We should write down every asset you have. So, we, in fact, at Anand Rathi, don't like to give advice unless we see the full picture. Okay, so we have a format. Please put all your assets in that format. You will at least know, because I meet some people, they say I have 3 crores. Then I ask them to add this, I ask them to add insurance policies, I ask them to add PPF, then I ask them to add their small land parcel. Then they get to know, oh, I'm actually at 8 crores. When you put all of it, when it is out of sight, you will not be able to apply management. So please draw up your balance sheet. In fact, I update my balance sheet once a month and see how I am progressing. Every month I have a target of where should my balance sheet be, where am I today. The difference is noted. If you ask me what was your balance sheet in the year 2011 on this specific day, I'll be able to tell you, because that Excel sheet has monthly updations. So that gives you a fair idea of what is my balance sheet. Then after you draw the balance sheet, you say, if I make no changes to it, where will I reach? If you are happy with where you reach, then make no changes. If you are not happy with where you reach, then you should make changes, right? So drawing up balance sheet is very critical. And once you draw a balance sheet, there's more clarity in this process of wealth management. After that, you might give if you're doing this exercise with Anand Rathi, after that you give only 10% of the money to Anand Rathi, I'm okay. But at least do the balance sheet.
Interesting you bring that up, that somebody actually comes up thinking that they have 3 crores, but they actually have 8. Let's talk about the reverse scenario, where they think that they have 8, but they actually have 3. Okay.
Wow, wonderful.
Because, I mean, I don't know if, I don't have anywhere close to crores, but that's probably going to be my scenario someday. And it'll be like in much a fraction of that wealth. Part of that comes from this whole idea of real estate. Correct. Real estate wealth, right? And I'm not quite sure what the scenario is like in Chennai. You can educate me on that. And I'm sure your RMs have a lot of lucidity when it comes to that. But there's a whole concept of real estate wealth as well as illiquid wealth, so to speak. What is the kind of findings you have? I know you haven't been a big fan of real estate investment, so to speak, but there is a huge bent we have as Indians towards investing in real estate, as well as our idea of how much of that really contributes to our wealth. So like a house in a fabulous area in Delhi, for a lot of people means a lot more than having so many crores under management with so and so. Tell me how this whole scenario has changed, or has gone towards what you had initially said years ago, which is that real estate perhaps is not as golden as it appears.
Correct. Fatima, yeah, I hope it's not the reverse case for you.
It's definitely going to be, but not in crores.
She's a modest lady. She tracks markets day in and out. I'm sure she's made a lot of wealth. No. Coming back to the point, your liquidities is very critical. Real estate, of course, if a wealth advisor tells you real estate will not do good, people will take it with a pinch of salt, saying that he's supposed to badmouth real estate so that he gets money. But 5 years back we said that. But if there is a time when real estate can again do well, I would say it is at least 3-4 years away. Okay. And it is not so soon in India that it will come back in flavor. The second finding is that India has 60, if we all put all our balance sheets together, meet again after a week, we will get an average of 60% in real estate. That's the Indian high net worth individual investment in real estate other than the house you occupy, right? So globally it is 18%. Indians have some extra knowledge about real estate. I don't know where it comes from, but they have 60%. So either the foreigners are dumb or we are. Now, at least for the last 5 years, we have been proved dumber. But there have been situations where real estate has made money. We get very emotionally attached because it has made money. But the next 10 years is very different than the past 10 years. Just because Nifty made money last 10 years doesn't mean that it will make money next 10 years. But if I have a house which I bought at 1 crore, if it is 10 crores, it might not become 100 crores in the next 10 years.
Sure.
But I'll be so emotionally attached to it that I will never be able to let it go, because it transformed my 1 crore to 10 crores. So create liquidity. There are 2 stages in life. One is growth, the other is consolidation.
Okay.
in the consolidation phase, most of our clients are in the consolidation phase. Consolidation phase, real estate has very little relevance.
Okay.
So if you're in the growth phase, if you want to get to 30 crores, 40 crores, 50 crores, you've already got there, 10 crores, 20 crores. Now you say, let me consolidate and make life simple. Then real estate has not too much relevance. Real estate in India, 5 years back we would have told, again it is borrowed opinion, it was not our smartness, I'm being very honest here. Raghuram Rajan, who was the RBI governor at that time, made a super statement, very, very strong statement saying that real estate is a bubble. I just copy pasted him and wrote an article on ET. He also said, fools will invest in real estate. In 2013 he has said. So when Raghuram Rajan, after seeing such data, in being in such responsible post, is making such statements, and it was not even highlighted. If he said the same thing about equity market, I would have got at least 500 calls next day. Feroze, you're such an idiot. Raghuram Rajan is saying it will go down, you're saying it will go up. For real estate, our love is so much that we can ignore anybody. Right? That's, if you see the article, he says, fools invest in real estate. Which RBI governor is going to make a reckless statement like this unless he has seen data? So, and the opinion is the next 3 years can't be. So what you have to do, you have to try and sell 10, 15, 20% lesser than the peak value, get it liquidated and put it on the path of growing, if not status quo. So that's the recommendation.
Okay. And just as I sort of end our part of the discussion, because I think we have a very captive audience who's been listening very carefully, and I'm sure this is an opportunity for you to come back with questions. One more question that I want to ask you about is the whole idea of debt. And how wealth management is really addressing that with HNIs at the moment. Because debt, of course, is seen as something that is necessary, but at the same time, it can really be quite a bummer, so to speak. It completely depends on whether you're looking at it as an entrepreneur or whether you're looking at it as an investor itself. How do you really feel, how much debt do you think should be weighing down HNIs, and how much diversification do you think also should be existing in portfolios going forward?
Very, very good question, Fatima. I think we should all be concerned about this question. And if there are a couple of points which you need to implement on your portfolio, whoever your advisor is, that's immaterial. Debt is something which you are lending money to somebody because you don't like risk. In the non-risky portion, if risk starts coming, then it hurts immensely. Where you're prepared to take risk, it is expected for equities to go up and down. When you lend money to somebody and he goes bankrupt, a AAA rated company, it's a wake-up call. Now what can you do? Firstly, if you have invested in debt, debt is nothing but lending to companies, is debt. So in your debt portfolio, you might have 5 mutual funds. You have to check inside the 5 mutual funds, how many bonds are there. If you don't already know it, that means you have not done justice to your money. You should have at least 100 bonds, at least 100 bonds. So to answer your pointed question, what is the right diversification on the debt side of the portfolio? If out of my 100 rupees, 40 rupees is in debt, this 40 rupees should be distributed across 100 different companies through mutual funds.
Wow.
Because in a mutual fund, there are 20 bonds, 30 bonds. So if you buy 6, 7 mutual funds of a specific nature, you should at least get 100, 120 companies. Even if 1 or 2 companies or even 5 companies go bankrupt in a very bad situation, it should not lose you more than 6 months return. If 6 months return goes away, I know my back will not break, right? I will still move on. If 50% of my money goes away, then my back is broken. I will never be able to overcome it. So that's the right amount of diversification.
Okay.
So 100 companies should minimum be there in any HNI debt portfolio. How do you check that? Your advisor should have already checked it, or if not, if he has checked it, not shown it to you, you should know how many companies you have lent money to, especially in a situation which is very, very shocking. Rating, to my mind, in India, I have not believed in them for the last 7 years. I have not believed in them, and I have been very vocal, at least on media, saying that I don't believe in rating. Of course, on recorded, I'm saying that it might not sound very good to some people who are in the rating business. Because, just look at this data, US is a very, very large country, the biggest GDP, You know how many companies are AAA rated in the US? 2. Only 2 companies have been able to get AAA rating. In India, AAA rating has been distributed. 38 companies in India. Are you saying US corporates are significantly lower credibility than these 38 Indian corporates? I doubt that. So rating agencies in India have been far more generous, reasons best known to people, not to me. So use something called Z-score. Okay, I'll just leave it at this word. Use Z-score. You are duty bound to take care of your money. Right? Now what can happen is you can say, I trusted the advisor. He gave me the wrong instrument. Yeah, there is also Mr. Narayan Murthy's proverb which is so inspiring. He says, in God we trust. Everybody else, please bring data. Okay, so you can't say I invested on trust. You have to ask for the data. What is the Z-score of this company? I see people buying one bond. Mutual fund is still okay because there will be 30 bonds. 2 of them will go bankrupt. You will still survive. It will not hurt you beyond 3 months, 6 months, 1 year. If you have bought a bond with your hard-earned retirement corpus, right, and we have not even checked the Z-score of that company. Z-score is invented by a person who in 1967, 52 years back, by a gentleman called Edward Altman. This is used as the most prominent method of checking whether the company is credible or not. And in fact, because I have been doing his prachar, I have been publicizing him, so we called him and he came down to India. Mr. Altman, Edward Altman is still alive and he's an 87-year-old man who is very wise. He came and did an event with me in Mumbai. So please use this Z-score to lend your money to any company. Who will calculate it for you? Either your current advisor. If your current advisor is not able to, then I'll be more than happy to do so. Because we have 3 people, thankfully Mr. Edward Altman has created employment in my company. 3 people only calculate Z-score. So if you wish to have any company's Z-score, you should get that computed. That will give you a better indication whether the company is strong enough to lend your money. So that's the second tip on the debt side. Diversify more than 100 bonds. We have to go check how many do we have currently. If there are only 60 bonds, you might want to re-engineer your debt portfolio. If the Z-scores, if you have individual bonds, like somebody told you buy this NCD, buy this fixed deposit of a corporate. If you have individual, please calculate at least Z-scores for those individual, if not for the mutual funds.
Okay, and because I can't resist, and after this it is going to be open to the floor, one quick question to you. How often should investors be reviewing their portfolios?
1 year. You can monitor it every month. Okay, you should monitor it not more than every month. You should monitor it. You should meet your advisor once a month. Along with that monitoring, you should always keep the next in line in the room. The day I am not there, my wife might need to take over the portfolio. So she has to be there. Or if it is wife's money, husband has to be there in monthly meetings. So that in several meetings, 10 meetings, 20 meetings, 30 meetings, the other person is also clear and aware of what is happening. Otherwise, wife says, I am not interested. Sometimes husband says, I am not interested. Child says, no, I am a photographer, I am not interested. Yeah, it is not a choice. God has been kind to give you more money than you can spend, so it's your duty. It's not an optional subject. So point 1, you should monitor it every month. Point 2, you should definitely have, the day I am not there, who is the next guy? That next guy, the reason why I am the deputy CEO, and my CEO, who is my professional guru, 64-year-old gentleman, very wise gentleman, he has made me his deputy because you guys have all trusted your money with me as a company. So if he is leaving this company or leaving this world, which is possible, right? Of course, it's a certainty. We don't know the dates. Both of us will not be there. So there has to be the next in line to continue the strategy, right? You can't say this person is not there, so strategy will be new. So that's my second tip. 1 year you have to do a full-fledged review, monitoring on a monthly basis. Don't ever monitor your portfolio because quite a few companies come and say, I'll give you online access. Check it every day. What do I do with checking every day? Yeah? Check it maximum 1 month. 1 month is also it's a reason for me to meet my client and appraise him rather than so 1 year strong reviews, full-fledged reviews in April are very critical of how the year went and why did it go the way it did. and monthly monitoring is good idea.
Very nice presentation. Good questioning as well.
Thank you.
Country has set an objective of becoming a 6 trillion economy. That's what we hear Honorable Prime Minister saying. Now, if you look at our growth in the last 4 decades, some people say it's moderate. Do you think this kind of a growth is enough for us to achieve 6 trillion economy? And all our investors, our wealth management is linked to this. Your opinion on that?
Yes, so fortunately we are one of the fastest growing this size economy. People actually don't realize enough that when this government came, we were the 10th largest economy. This year we are the 5th largest economy in the world. We have overtaken UK mostly this year. So it's of course growing at a very, very rapid pace relative to other people. So is 6 trillion possible in the next 10 years? If the rate of growth in the next 10 years needs to be 11%, if it grows by 11%, at least including inflation it can grow. Okay, nominal GDP can grow, but the real GDP might not grow to 6 trillion in my opinion. 6 trillion is a little aggressive. But what we don't need to actually grow, we need to bring the economy, which is the parallel economy, into mainstream. See, when US has a certain economy size, it is the full economic size, because there is not a large parallel economy of cash. In India, there is a huge parallel economy which is not being measured, which is another kicker for our economy when it comes to mainstream. And what will bring it to mainstream is GST. GST has the potential to bring it to mainstream. In the entire chain, now if there is a bottle of water, there is somebody who's doing the bottling, somebody is doing the printing of the label. If one person pays tax, everybody needs to pay tax. Earlier, if one person says, I will pay tax, he will go down the drain because everybody else will not pay the tax and compete with him. So GST has the potential over the next 5-7 years to bring the parallel economy into mainstream to a certain extent. So I am reasonably bullish that the economic growth will be there, and you're absolutely your point that our lives will be dependent on economic growth. You are right. Our lives in the short term are dependent on news, whether attack happens, retaliation happens, budget, what happens. In the medium term, markets and our lives are dependent on corporates. How much are they earning? How much are these big companies earning? In the long run, we are dependent all on the economy. You're right. But then comes the advisor. If he can give you an extra return, then that becomes your bonus.
You talked about the 4-month strategy to protect downside. And now, could you elaborate on that, or would our advisor talk about it? I mean, because it's, I think, very topical at the moment, and it's important for us to understand how that's going to be done. No? Second question, just so I cover both. You also talked about the Altman Z-score, and the sites like Value Research, all of them give Altman Z-scores. Can I rely on them, or do you think this computation is fairly done differently by different people?
No, I would definitely rely on Value Research for sure. Of course, it's one of the person I know, Mr. Kumar. So Value Research is one of the most credible sources to get Z-score. It also gives you some other scores which are very, very important if you wish to be on the driver's seat and check. So Z-score, C-scores also it gives. So you can rely on Value Research Z-score. Z-score is a very easy formula. If somebody has the balance sheet, there are 5 components to it, X1 to X5, X1, X2, X3. You just have to put those numbers and the Z-score comes. So you can rely on that. You should not rely on the Z-scores completely on financial services company. For manufacturing company, Altman Z-score is the best method ever. For financial services companies, you can also use another method. So I'm putting my disclaimer. Coming back to the first question, is how do you create a 4-month strategy? So it's not a product. I will, rather than giving you a product, I'll tell you the formula of how you can achieve this. How can you protect your downsides and still be in the market without being worried whether elections can spoil my party and take away all the return I've made. only for you, sir. If somebody doesn't interpret it, it's okay, because this could get a little technical. So what, like one client I had, he was very, very paranoid. And I said that this makes no sense for you to be so paranoid till May, if you have your hard-earned money. So if you remove all your money, for example, this is not a blanket recommendation. This requires a strategy and specific understanding of the human being, which I don't of the group. If you remove the money from equity, let's assume this gentleman had a reasonable exposure to equity, that's why he was worried. You remove the money. Let's assume 100 rupees is there in equity, you remove it. So is it now protected? Of course, you've removed it. But the problem is, if market goes up, you're not in the game anymore. You've left the market. So you remove it. Now when you remove your 100 rupees, what can you do with your 100 rupees? You can put into fixed deposit. Of course it is very safe. But now you have nothing to do with the market. If you have nothing to do with the market, if Modi ji comes back to power and the market goes up 30%, you've lost all the 30%. So you should not do that. You should take the money out, put that into fixed deposit. Step 1. Will fixed deposit give me 3%, 4% return for the next, till the budget time? Till June it can give me 3-4% return. Till June. This is 4 months, whatever. Add 1 more percent to it. With 4 or 5%, you can buy something called a call option. You can buy a call option. Call option means, okay, it's very simple. It's not as complex. So what did you do? Step 1, removed your money from equity. Step 2, put it into fixed deposit. So now your 100 rupees is very safe. You take the return which you are expecting from the fixed deposit, not your capital. Take 1 rupee from your capital. So 4 rupees is from the return, 3-4 rupees is from the return, 1 rupee is from your capital. Take that money. Now how much money do you have? 5 rupees. With this 5 rupees, what do? You buy a call option. What do you mean by call option? It is very simple. I took my 5 rupees, buy a call option. With this 5 rupees, if the market goes up 30 rupees, you will get 30 rupees. If the market goes up 20 rupees, you will get 20 rupees. Call option means how much ever market goes, I will give you that. If the market doesn't go anywhere, the entire 5 rupees is gone. But you still have your 100 rupees here. If market goes down, what happened to your 5 rupees? Everything is written off. But I still have my FD, which is 99 rupees. So if the market goes 30% down, what will you lose? You will lose 1%. If the market, then if it goes down, what will I do for my client? I will take the 99 rupees and buy the same mutual fund at a cheaper value. Understood? So step 1, remove your money. Step 2, put it in an FD. Step 3, take the FD return. Take also 1 more percent, which is your cost. Buy a call option, step 4, and then just relax. In June, if the market is 40% up, you will get 40 from the call. You will get 40 from the call, 99 from the FD. How much did you get? You get 139. You got 1% less than market, which I will be okay with. But if the market went 40% down, your 99 in FD is there, 5 rupees of call option is down the drain. So call option price is as little as 5% for June. And now who will give me this call option? Anand Rathi is the largest provider of derivative on the exchange. So on the exchange you can get this call option for any amount, for as little as 50 lakhs to as much as 1,000 crores on any given working day before 3:30. So it's a practical suggestion, it's not an academic suggestion. So if somebody has not been able to interpret it, it's fine. But call options are very simple instruments. You put some money, if it goes up, you will get the entire return. If it goes down, you will lose everything of this 5 rupees. But you still have your 99 rupees safe.